Starting off by documenting assumptions, appears that we will have both income statement as well as balance sheet assumptions in here. Balance sheet assumptions would include the cost of $250,000 and the useful life of 20 years. In addition to that, there will be a salvage associated of $25,000. That makes us think that immediately somewhere along the line we're going to need to think about revenues and expenses, of which one of those expenses we know will then be depreciation expense on a yearly basis. The RV requires us to pay 10% in tax. That would be an expense that would come after our depreciation tax, 10%. Looks like there are some additional expenditures in terms of needing a driver, having to spend some gas, and then some insurance costs, all associated with our ability to run this RV. The revenue from parties looks to me, if we start to think about year one, because this thing is going to last 20 years, it's reasonable to go ahead and pull our years all the way out to 20. And it appears that the RV is expected to bring revenue of $100,000 per year for every year that we own it. Okay, the discount rate will be 10%. And what other information can we document? There's the $10,000 in gas that we're going to have to spend, 10,000. Put that across all 20 of our years. And the driver makes $30,000 a year. And the insurance is covered under North Park's existing policy, which means that there will be no additional expense from insurance because the costs need to be absolutely new. How can we go ahead and get depreciation? If we do straight line, we take the cost minus the salvage value divided by the number of useful lives. Since that's not going to change anywhere, I'm going to put the F4s all around it so that all the way across we'll get the 11,250. Now that we seem to have all of our documented assumptions down, let's project an income statement. So an income statement, we'll go ahead and reference these 20 years so that we don't have to retype all that stuff. I think we have too many years over there. Yes, indeed we do. Okay, so building the revenues and then expenses. We'll have cost of goods sold, and we'll have gross margin, SG&A, and then EBITDA, depreciation, expense, EBIT, interest, expense, EBT, tax, and net income. So the revenues we had documented up above, so we can just point and bring in. Gas and driver, we can assume then would be a cost of goods sold. You can't run an RV without having a driver and without having gas. Start dropping in our individual subtotals. There is SG&A, which would be insurance, of which we don't have to worry about any, but we do have another subtotal of gross margin minus SG&A. Put a line over here so that we can see the subtotal that existed over there. I actually have to move this line because we want it to be here. All HBO as well as right there. Okay, depreciation expense, pull in from above, EBITDA minus depreciation, give us a subtotal line. Interest expense is 0, therefore EBT is EBIT minus interest, add another line. Our tax is going to be equal to our earnings before tax multiplied by our tax rate. I could put the tax rate all throughout, so I vary it for years, but because I just stuck it in one box, it makes sense to go ahead and affix that reference there so that we can come up with a net income of $43,875. Once that's all done, since we laid this out nicely, we should be able to just copy and paste this thing all the way across until year 20, deleting that which we don't need, and now we have an income statement that runs for those full 20 years. Pulling together then the NPV model, cash flows in, cash flows out, cash flows net, present value, NPV, and IRR. Those two also need our periods, where we start in period 0, and we're going to run out to the 20th period. So our cash flows in will be equal to the revenues. Cash flows out are equal to our cash expenses, which would be the COGS plus any SGA plus any interest plus any tax. Cash flows net is then equal to in minus out. And we can copy and paste that all the way across since the formula structure remains the same. How does this all kick off? Because the first thing we have to do is buy an RV for $250,000, which tells us that we would have to make that expenditure in the first period, from which then we calculate present values, where the rate we have notated in our assumptions as 10%. It won't move, so we affix it. The number of periods is 0, no payment, so we move past it. Switch the sign on cash flows net, copy and paste that over, and we see the declining value in our net cash flows over time, so that we can calculate our NPV as the sum of all those present values, and then our IRR as being a value calculated off of the cash flows net, leaving us then with an NPV of $219,000 and an IRR of 21.61.